Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. This is episode 2 of my long-running series, 2 episodes about my stock buyback portfolio. I did one video about this when I started the portfolio back in March. I will link it down below. If you're new here, welcome to Time in the Market. This is a channel about long-term investing. Remember to like and subscribe. I've been told that I never say like and subscribe, so I've done it this time and I'll never say it again. I'm sorry about that if you're a new viewer or an old viewer who doesn't expect it. So this portfolio is very much focused on companies that are fairly valued, and that's obviously, in my opinion, generating decent to significant free cash flow and using the majority of this free cash flow to buy back shares. That's the idea behind this portfolio. This isn't going to be a portfolio full of common growth names. I have other portfolios for that. This is very much a fun thing to do on the side, to try a different strategy that's focused very much on stock buybacks, companies that are reducing their share count by 30 to 50% in the last decade or so, and hope to continue to do the same for the next decade. The idea being that, hey, even if your net income doesn't grow, as long as you're reducing share count by a significant amount, your earnings per share can grow significantly. Maybe you get re-rated by the market and the long-term returns will be very solid. Of course, I think these companies can still grow net income, grow net revenue. So it will be a combination of growth, re-rating, reduction in share count to generate higher EPS that'll yield long-term returns. And we'll see how that plays out across the years. And I'll change this portfolio around from what it is today to what's going to be in the future based on the valuation of these companies, returns, performance, etc. So it's not a fully passive portfolio, but it's relatively passive. I've only really touched it once since the last video, besides investing $250 a week every single week into this portfolio to keep it going, to keep it growing. And as you look at the portfolio, we've got a nice little staircase here. Obviously, a lot of the initial growth from a portfolio like this will come from the contributions. We've got $250 a week going into this uneven staircase, driving the portfolio higher and higher. Market gains are there too, up about $260. But again, when you talk about the $4,000 value, it's mostly net cash flow, some dividends, but a lot of these companies do not pay dividends. When we look at the stocks in here, we've got Jackson Financial, Crox, Toll Brothers, Builders First Source, PayPal, Booking Holdings, Owens Corning, MGIC Investment Corp, NMIH Holdings, Gildan, ASO. I won't go into details about a lot of these companies. Some of you might be familiar with, some you might not. If you want to know more about any of these, leave a comment down below. Maybe I'll make a video about them. In the last video, I had Cooper Group in here. That's been removed since they were bought out by Rocket Mortgage. You know, I got a 30 to 40% bump out of that buyout, but I would have liked to held that stock for a while since it was my number one position. I readjusted some of the weighting and I added Gildan Activewear and ASO, Academy Sports and Outdoors, a retailer of sporting goods. Those have performed well. These mortgage insurers have performed well. If you see a theme here, it's, hey, there's a bunch of housing stocks in here. You know, Owens Corning, MGIC, NMIH, Builders First Source, Toll Brothers, really dependent on how the housing market is doing. And right now it's a struggle bus over there in my mind. You've got high interest rates. You've got expensive costs for materials when it comes to builders or home improvement companies like Owens Corning and Toll Brothers. You've got housing prices that are very high. So people just aren't moving, especially those that have rates that are 2.75% or lower, like I do. It's very hard to buy a house today if you already own one. It's very hard to buy a house today if you don't already own one and want to buy one, just because of a variety of factors that are out there. If interest rates drop in the future, that will obviously be beneficial to some of these stocks. The other stocks here are very customer centric. So if you feel like the economy is not going to do well in the mid to longer term, that's probably not a good thing for companies like ASO, Gildan, PayPal, Booking, with travel, Crocs, with little fancy shoes, not fancy, little silly shoes, I suppose. So that's kind of what you're getting with a portfolio like this one. It's very focused. It's somewhat cyclical, but that's kind of the idea here. Cyclicality helps the long-term returns. If you have a long-term mindset, the reason Builders First Source has been such a good compounder, because when prices drop and the economy isn't doing well or the housing market isn't doing well for a brief period of time, these companies are still generating free cash flow and buying back shares at very opportune times. And that's the thing I want. And this is The idea behind this portfolio is to hold these stocks for a long, long period of time. I'll certainly sell here and there. If suddenly Crocs goes up 120% in a matter of a couple of weeks, probably moves out of that fairly valued range in my mind. But until that happens, I'll be holding, I'll be looking at their earnings, making sure they're still generating free cash flow, making sure they're still operating as a good business and growing a bit or at least staying consistent, and more importantly, buying back shares because that's the long-term strategy here. And you can visualize that here. You can kind of see the stocks laid out, all 11 stocks in the portfolio. You can ignore their PE ratios. There can be some messy stuff there depending on acquisitions, whatever it is they're doing, what type of business they're in. I'm looking at free cash flow. I'm looking at enterprise value. Here are the free cash flow yields based on 2024 actuals. You can see that these companies are trading anywhere from a 4% free cash flow yield for Gildan up to a 12.6% free cash flow yield for a company like Crocs. There's certainly a lot of pressures for a lot of these companies right now, which is why they're trading where they are. For some of these retail plays, the customer might be weak. Tariffs are impacting their ability to sell stuff at higher margins. For some of these housing plays, you're looking at a housing market that's cooling off a bit, and that's certainly a negative for companies like Builder and Toll Brothers and MTG and NMIH and OC. Stuff's expensive. People aren't buying stuff as much anymore. They're not changing houses. Interest rates are high. All of that stuff compounds and drives a reason for these stocks to trade where they are. On top of that, some of these stocks are cyclical, so cyclicality can drive different pricing dynamics for a company like Builder. Obviously, Builder generated $1.5 billion in free cash flow in 2024. For 2025, their expectations are just under $1 billion. Still pretty good, still a good value in terms of their free cash flow yield against what the market's trading at. But when you see that type of decline, it certainly worries investors. However, this is kind of the beauty of this type of investment styles, that this cyclicality can be helpful, as I've mentioned. If you look at what they did in 2024 based on their actual free cash flow and their actual stock buybacks offset by stock-based compensation, these companies are reducing their share counts by 2.5% to 11.5%. So a lot of them are using the majority of their money towards share buybacks. Some of them are even taking on additional money to fund share buybacks, given their decent valuations, and they're reducing their share counts by a lot. So even if their net income doesn't grow for a company like Builder, for example, their EPS is going to go up 11.5% just on the basis of the fact that they're reducing their share count by 11%. So this is assuming that they continue doing the same thing based on today's market cap. Obviously, they might have actually bought at a higher price, so maybe the share count reduction was a bit lower, but that's just kind of a view for you to see what the strategy would be. And some of these stocks aren't buying back as many shares as others. For example, NMIH is a mortgage insurer. These are companies that provide the mortgage insurance you buy if you don't put down more than 20% when you buy a house. So it's when you're paying PMI, you're paying it to companies like NMIH or MTG. And these are awesome businesses as long as the housing market doesn't crash. If a 2008 type recession happens, these businesses are screwed. But if it doesn't, these companies have combined ratios in the 25 to 30% range, which means they're making 70% in net income from the premiums they're collecting, which is amazing in the insurance game. So they do have to meet certain ratios to be allowed to do that by the government. MTG is a more mature business. That's why they're buying back 8.5% of their shares, 8.3% of their shares rather, because they've met those ratios. NMIH is still new. They've just started getting there. So they're instituting a share buyback for the first time in a while. And I think that's going to tick up quite a bit in the future. From a valuation perspective, awesome valuations. This is a very consistent business. I own more of these shares in other portfolios. Love this business. And again, obviously, if a housing crash happens, you're boned, but that's why you kind of make this a small position in your overall portfolio to account for that risk. Cyclicality here is going to matter. These companies aren't going to generate free cash flow every single year, the same free cash flow every single year. They're going to have ups and downs, but as long as they keep buying back shares consistently, whether it's $1 billion in 2025 versus 1.5 billion in 2024, maybe they'll definitely they will eventually rebound. Cyclicality is such that it cycles down, but it eventually cycles up again, and you have to be aware of that as an investor. People are going to need housing. That's just the cold hard truth. People are going to eventually live in a slightly better economy, and these, consumer-based stocks like ASO, Guild, and Crocs, etc., will eventually do better. PayPal as well in the payment space. Certainly some pressure in the payment space, but again, PayPal is still a pretty good business. Booking, travel, certainly pressured a little bit by some of the rhetoric out there in terms of whether or not people are traveling to America, they're going elsewhere, whatever. Still an amazing business, still going to do well. Certainly kind of expensive in relation to the rest of the portfolio. So is Gildan. Companies I'll certainly keep an eye on. When you look at this portfolio, it's going to be mainly passive, but once stocks have a significant return, if stocks aren't doing well in terms of their financial performance, in terms of the buybacks they're executing, instituting, etc., they might be removed from a portfolio. If there's ever a buyout like there was with Cooper, it might be removed from a portfolio, and I'll always be on the lookout for other companies that I can add to the portfolio. So that's the main brunt with this portfolio. I think it's a fun one. It's companies that I wouldn't normally buy, companies that I wouldn't normally look into because they're not, high growers, they're not high flying, exciting companies. They're kind of boring, steady eddies that are eventually going to have a good compounding return, because the idea here is, one, you're going to get an 11.5% return from the share buyback. This free cash flow yield maybe will eventually be re-rated because the business will be better than it is today. And from an 8%, you'll go to a 6%. On top of that, in a couple of years, you'll get back to growth again, and your EPS will jump up quite a bit just because the business is booming again. And you'll have this massive return from a company that just kind of looks boring and bland, because you combine the share count reductions, the net income growth, the top line growth flowing down to the bottom line, plus a potential re-rating, and you could have companies that are looking boring today that are trading at a 12.6% free cash flow yield, trading at a 7% free cash flow yield a couple of years from now, combined with the share count reduction, combined with net income growth, and you're talking about 20% plus annualized returns from here. That's the idea. You hit a couple of those in a portfolio like this one, and you're doing pretty well overall. It might not pay off immediately. It's not a high-flying, exciting stock like NBIS, which I've done videos on before, that it's doubled in a matter of months, but it's boring. And that's what investing should be sometime. And that's why I'm following this strategy for a part of my portfolio, because it's boring, not exciting, but it's also fun to see how it does in relation to some of my other portfolios. So let me know what you think down below. Again, this is not investment advice. Please do your own due diligence before investing in any stocks mentioned here. I do own all of these stocks and potentially others that I've talked about in videos here and prior to these videos, so keep that in mind. Please talk to a qualified financial professional before making any investment decisions. If you like the video, like it down below, leave a comment, all of that good stuff. And as always, thanks for watching. Bye.